Should silver be trading at $72, or is the real number closer to $275, or even $1,180 per ounce? That question sounds extreme until you stop looking at silver through the lens of paper pricing and start looking at it through the lens of physical stress, monetary history, and structural imbalance. What is happening right now in the silver market is not normal. It is not cyclical noise. It is not speculative hype. It is a breakdown in price discovery. Let us start with the surface. The spot price of silver recently closed near $72.89, while futures traded slightly lower, around a $72.26. That detail matters more than most people realize. When spot trades above futures, the market is in backwardation. In simple terms, buyers are willing to pay more to get silver now than to wait months into the future. That only happens when supply certainty disappears. Backwardation is not about excitement. It is about fear of non-delivery. This is extremely rare in precious metals, especially silver. Futures markets are designed to price time, storage, and confidence. When that system inverts, it signals stress in the physical layer. Investors who hold real metal are no longer passive. They are demanding immediacy. They want bars now, not contracts later. Now zoom out. Over the past year, silver completed a confirmed long-term technical breakout. On a yearly chart spanning decades, silver formed a massive cup and handle pattern stretching from 1980 through 2024, followed by a decisive breakout in 2025. Each bar on that chart represents an entire year of global economic pressure. When a structure that large resolves, it is not reacting to news. It is reacting to history. Respected technical analysts have identified a long-term target near $275 per ounce. That does not mean silver moves there in a straight line. Corrections are normal. Volatility is guaranteed. But the magnitude of the structure suggests a repricing, not a rally, and that repricing aligns with fundamentals. The most important fundamental fact is this. The silver market has been running a supply-demand deficit for nearly 6 consecutive years. More silver is being consumed than mined, year after year. And unlike other commodities, silver production cannot be quickly increased. Roughly 70% of silver comes as a byproduct of mining copper, zinc, and lead. You cannot simply turn a silver dial and produce more. This matters because, for decades, silver prices were artificially suppressed. Whether through futures leverage, short positioning, or financialization, the result was the same. Low prices discouraged exploration. Companies abandoned silver-focused mining. Capital flowed into gold instead. The pipeline dried up. Mining is not software. It is not scalable on demand. Discovering, permitting, financing, and building a silver mine takes a decade at best. And even then, success is not guaranteed. The silver required to close today's deficit has not yet been discovered. It is not sitting in reserve. It does not exist. Now add another signal. The physical retail market. 100-ounce silver bars, traditionally the cheapest form of silver per ounce, are now selling at massive premiums. Some dealers list them above $80 per ounce. Others show pre-sale only. Out of stock, delays, warnings of high demand. That is not normal behavior. 100-ounce bars are not collector items. They are used by institutions, high net worth buyers, and industrial scale investors. When that tier tightens, it suggests large players are accumulating physical supply, quietly, systematically. Price discrepancies across regions confirm the stress. Reports indicate silver trading around $130 per ounce in Tokyo, $80 in Shanghai, and barely above $70 in New York. Same metal, same day, same ounce. One of those prices is false. Markets cannot sustain that divergence indefinitely. When arbitrage fails, it means metal is not freely moving. Logistics are constrained, vaults are tightening, export rules are changing, and that brings us to China. China has imposed export controls on silver. Licenses are now required. Only a limited number of firms qualify. Minimum production thresholds are high. In effect, roughly 60% of global refined silver supply has been placed behind administrative barriers. This is not speculation. This is policy. When a country that dominates refining locks supply, the global market adjusts upward. Slowly at first, then suddenly. China understands silver. Historically, silver was China's monetary foundation. When the United States weaponized silver pricing in the 1930s, China learned a lesson it never forgot. Control the material or be controlled by it. This is not about silver as an investment. It is about silver as leverage. The paper market tells a different story, and that is the problem. In a single trading day, over 800 million paper ounces of silver changed hands. That is nearly an entire year of global mining output traded in 24 hours. No physical market can support that. It is a mirage, a financial abstraction. When paper volume dwarfs physical reality, price loses meaning. Eventually, physical demand reasserts itself. That process has begun. This is why some analysts reference numbers like $1,180 per ounce, not as a prediction, but as a ratio. The US debt clock measures the annual expansion of the money supply divided by annual silver production. Gold and silver are not priced in dollars. Dollars are measured against gold and silver. That distinction matters when currencies decay. This is not a story about upside. It is a story about damage, and it has only just begun. To understand why silver is behaving this way, you must stop thinking in terms of price and start thinking in terms of trust. Every market is built on trust. Trust that contracts will be honored. Trust that supply will be available. Trust that price reflects reality. When trust breaks, price stops making sense. Silver is now exposing that break. For more than 50 years, silver existed in a managed environment. Futures markets expanded far beyond physical supply. Short positions accumulated without delivery. Paper ounces multiplied while real ounces remained scarce. The system functioned only because most participants never asked for metal. They settled in cash. That behavior has changed. When physical demand rises, the paper market becomes fragile. This is exactly what we are witnessing now. The increase in margin requirements on silver futures was not random. It was defensive. Exchanges raise margins when volatility threatens systemic risk. The goal is not stability. The goal is to flush out leverage before it breaks the system. Yet despite margin hikes, open interest remains concentrated. That is critical. It means the longs who remain are not short-term speculators. They are positioned deliberately. Meanwhile, the short side is thin but heavily exposed. Every upward move increases pressure. This is how squeezes begin, not with hype, but with imbalance. The question Ed Steer asked is the most important one in this entire story. Where will the silver come from? The answer is uncomfortable. It will not come quickly. Global silver production has been trending downward since 2016. At the same time, industrial demand is rising. Solar panels, electric vehicles, medical equipment, electronics, defense systems, and data centers all require silver. Unlike luxury goods, these industries cannot substitute or delay indefinitely. This is what economists call inelastic demand. When price rises, consumption does not fall. It continues. That is a dangerous condition when supply is constrained. Now consider mining incentives. For decades, silver prices were too low to justify exploration. Capital avoided the sector. Talented engineers moved elsewhere. Projects were shelved. Some of the largest silver miners pivoted toward gold because silver no longer paid. This created a hollow pipeline. Mining responds to price, but with a long delay. Even if prices remain elevated, new supply may not arrive for 10 years. And even then, extraction costs are rising. Energy, labor, environmental compliance, and geopolitical risk all increase the cost curve. This means higher prices do not guarantee relief. They may simply reflect scarcity. Now return to the physical market. 100-ounce bars are not symbolic. They're diagnostic. When small retail products sell out, it can be noise. When large bars disappear, it signals institutional accumulation. It means entities with capital are choosing metal over paper. That choice has consequences. In multiple regions, dealers are reporting delays, pre-sales, and restricted availability. Premiums are expanding not because of greed, but because replacement risk has increased. When a dealer sells inventory, they may not be able to restock at the same cost. That risk must be priced in. Outside the United States, conditions appear tighter. Asian markets are paying higher prices because delivery is immediate and physical. Western markets remain anchored to futures pricing, which is increasingly disconnected. That divergence cannot persist forever. Now add geopolitics. China's export controls change everything. Silver has been classified as a strategic material. Licenses are required, thresholds are high, compliance is selective. This is not a ban. It is more effective than a ban. It allows discretion. China controls a dominant share of global refining. Even silver mined in Latin America or Australia often passes through Chinese infrastructure before becoming usable. That gives Beijing leverage without headlines. Control refining, and you control flow. This strategy mirrors rare earths. China did not weaponize them overnight. It regulated them. Over time, prices rose, alternatives lagged, and dependence became visible. Silver now follows that path, but with a critical difference. Silver is everywhere. Restrict silver and you constrain energy transitions. You constrain AI hardware. You constrain military production. You constrain industrial growth. This is not about investors. It is about systems. That is why the paper market is under stress. It was built for liquidity, not scarcity. It assumes metal can always be sourced. When that assumption fails, leverage becomes lethal. The massive paper volume traded daily is not proof of abundance. It is proof of fragility. When hundreds of millions of ounces trade without delivery, price becomes an illusion. Eventually, physical demand forces reconciliation. This is where the discussion of extreme numbers emerges, not as forecasts, but as mirrors. The ratio between monetary expansion and silver supply has exploded. Dollars multiply. Ounces do not. That gap must close somehow. Historically, currencies collapse faster than metals appreciate. The metal does not change. The measuring unit does. When people quote silver at $1,180, they are not saying silver becomes richer. They are saying money becomes poorer. That distinction matters. Silver has served as money for thousands of years. Empires rose and fell around it. Paper currencies came and went. Over a 4,000-year timeline, silver remained. That is not ideology, it is record. When central banks quietly accumulate gold and restrict strategic materials, they are not speculating, they are preparing. Gold restores trust. Silver powers the system. This is not a bubble, it is a transition. And transitions are never comfortable. At this stage, the silver story stops being about markets and starts being about psychology. Every monetary transition follows the same pattern. First, denial, then confusion, then disbelief, and finally, panic. We are now between disbelief and panic. Most people still measure silver in dollars. That is the mistake. Silver is not becoming more valuable. The dollar is becoming less credible. When prices appear extreme, it is usually the unit of account that is failing, not the asset. This has happened repeatedly throughout history. Roman denarii, French assignats, Weimar marks. Every time, metals were blamed for bubbles, when the real problem was currency decay. This is why media narratives matter. When mainstream outlets suggest silver might be the next bubble, it is not analysis, it is conditioning. It frames a structural repricing as speculation. The goal is to discourage participation and maintain confidence in paper systems for as long as possible. But confidence is already cracking. The paper silver market is showing signs of internal stress that cannot be hidden. Margin hikes, reduced open interest, and violent intraday swings are symptoms of instability. These tools are used when exchanges fear loss of control. Yet despite these measures, the disconnect between paper and physical continues to widen. On a single trading day, more than 800 million paper ounces of silver were traded. That number should be alarming. It represents nearly an entire year of global silver production exchanged in 24 hours without delivery. No physical commodity market can support that ratio indefinitely. This is not liquidity, it is leverage. When leverage dominates price discovery, markets appear stable until they suddenly are not. The moment even a small percentage of participants demand physical settlement, the illusion collapses. This is why backwardation matters. It signals urgency. It signals preference for possession over promise. Now consider what is happening outside exchanges. Large bars are disappearing. 100-ounce bars, kilo bars, institutional formats. These are not impulse purchases. They are strategic. When individuals with scale accumulate physical silver, they remove float from the system. Each bar locked away increases pressure on remaining supply. This is how squeezes develop organically, not through coordination, but through rational behavior in a constrained system. China's actions amplify this effect. By imposing export controls, Beijing effectively signaled that silver is no longer just an industrial input. It is a strategic asset. Once a material receives that designation, markets must reprice risk. China is not reacting to silver prices. It is acting based on future demand. Artificial intelligence, electrification, automation, defense modernization. All of these trends require silver. China understands that controlling inputs is more powerful than controlling outputs. This is why China is accumulating silver quietly while allowing prices elsewhere to lag. Arbitrage funnels metal east. Western vaults drain. Eventually, export rules tighten further. Licenses narrow, supply thins. By the time the West responds, the leverage is already set. This strategy is not theoretical. It was used with rare earths. It worked. It forced competitors to scramble for years to rebuild supply chains. Silver is far more embedded in daily systems than rare earths. The impact will be broader. Now layer in monetary dynamics. The United States continues to expand its money supply. Debt grows, deficits persist. Real yields remain fragile. In this environment, hard assets do not rise because they are loved. They rise because currency confidence erodes. The dollar to silver ratio approaching 180 is not a price target. It is a stress indicator. It measures how much new money is created relative to how much silver exists. That ratio has exploded because one side grows exponentially while the other remains constrained. Historically, when such ratios diverge, reversion is inevitable. Either production explodes or currency contracts. Silver production cannot explode. That leaves currency adjustment. This is where time becomes critical. Silver markets do not move gradually. They compress. Long periods of inactivity followed by violent repricing. This pattern has repeated for decades. When constraints hit, prices overshoot, speculative capital piles in, volatility spikes, then corrections occur, but the baseline resets higher. This is why timing is impossible. The transition does not announce itself politely, it accelerates. What matters more than price is behavior. Are governments securing metals? Yes. Are export controls increasing? Yes. Are physical premiums expanding? Yes. Are futures markets under stress? Yes. Are investors choosing possession over leverage? Increasingly, yes. These signals align. The silver market is not broken. It is revealing truth. Truth about scarcity, truth about leverage, truth about the fragility of paper claims in a physical world. The next phase is not about charts. It is about access. Who can obtain silver at scale? Who cannot? Who controls refining? Who controls energy? Who controls time? Silver sits at the intersection of all three. This is why it matters even to people who never intend to own an ounce. Because silver is not just a metal, it is infrastructure. And infrastructure determines power. At the end of every monetary cycle, people ask the wrong question. They ask how high prices can go instead of asking how much trust has already been lost. Silver does not move because investors suddenly become emotional. It moves because systems fail quietly and then all at once. What we are seeing now is not a speculative frenzy. It is a structural reallocation of risk. For decades, the global economy relied on abundance assumptions, abundant energy, abundant materials, abundant liquidity. Those assumptions are breaking. Silver exposes that break because it sits at the intersection of money, industry, and geopolitics. When silver tightens, everything tightens. Consider the sequence. Central banks accumulate gold, export controls expand, refining consolidates, physical premiums rise, futures markets strain. These are not isolated events. They are coordinated outcomes of a world shifting from globalization to fragmentation. In that world, leverage matters more than efficiency. China understands this better than anyone. It does not need to ban silver outright. It only needs to control marginal supply, licenses, thresholds, refining capacity, timing. By the time competitors react, years have passed. That is leverage. The West faces a different problem. Its systems were built on financial abstraction, paper claims, futures curves, assumptions of infinite delivery. That framework works only when trust is intact. Once trust erodes, abstraction collapses into reality. Silver is forcing that collapse. The shortage of large bars is not symbolic. It is functional. It signals that institutions prefer ownership over exposure, possession over promises. When that behavior spreads, liquidity drains from paper markets and flows into vaults. This is how price discovery migrates. Meanwhile, industrial demand does not pause. Solar deployment accelerates. Data centers expand. Electrification continues. Defense modernization intensifies. These systems require silver regardless of price. That is the difference between discretionary assets and strategic inputs. In such an environment, price becomes secondary. Access becomes primary. This is why comparisons to past bubbles fail. Bubbles form when supply is elastic and demand is narrative-driven. Silver faces inelastic supply and structural demand. That is not a bubble setup. That is a pressure chamber. Even if price is correct, the underlying imbalance remains. Corrections flush leverage. They do not create supply. They do not shorten mine development timelines. They do not reverse export controls. They simply reset sentiment before the next move. Now consider currencies. The dollar remains dominant, but dominance is not permanence. Monetary history shows that reserve status erodes slowly, then suddenly. Central banks diversifying away from treasuries into gold is not ideological. It is defensive. They are reducing counterparty risk. Silver complements that move. Gold restores trust in reserves. Silver powers the economy that runs on those reserves. Together, they form a hedge against systemic uncertainty. This is why extreme ratios matter. When the expansion of money vastly exceeds the expansion of real goods, repricing is unavoidable. Either currencies adjust downward or real assets adjust upward. Historically, currencies adjust. From that perspective, numbers like 275 or 1,180 are not predictions. They are stress markers. They reflect how far the system has drifted from balance. The real question is not how high silver can go. The real question is how much leverage remains hidden in paper markets before physical reality asserts control. And that moment is approaching. The world is entering a phase where commodities regain strategic importance. Energy, metals, food. These are no longer neutral inputs. They are instruments of power. Whoever controls them shapes outcomes. Silver is small enough to be overlooked and critical enough to be decisive. That combination makes it dangerous. This is why export restrictions matter, why refining matters, why physical ownership matters, why futures markets are losing authority. The transition will not be smooth. There will be volatility, disinformation, attempts to stabilize confidence, margin changes, narrative shifts. All of that is expected. What matters is direction. The direction is away from abstraction and toward physical control, away from paper promises and toward real assets, away from universal markets and toward segmented access. Silver is not leading the shift, it is revealing it. If history is any guide, those who understand the transition early do not need to predict exact prices. They need to understand structure, incentives, constraints, time horizons. That is what Currency Archives exists to decode. Because in the end, money is not about numbers, it is about power, and power always leaves fingerprints. I am David Kim, and this is Currency Archives.